Listen here.
I have a
Let's
question
get
for you all.
started.
So I am helping uh, a property owner via a friend of mine. He actually represents the property owner. I'm looking for someone to purchase a multifamily development. It's in McAllen, Texas, and it's a 120 unit property. And it's very close to Texas A&M, one of their universities out there, just minutes away. And what they're doing is they're roughly 60% completed with the development portion of the asset. They just need a few more million to complete it. Like I think it's about 5.5 million to finish the project. So like all in all, it's a $15 million project, but they're wanting to sell it now at 9.5 million in order for them to be able to finish their retail project that they're doing. So, do you know of anyone that would be interested in that type of asset to purchase?
I don't.
Not off the top of my head. I would say
Okay.
that's a might be a little bit difficult only because now whoever is actually doing the developing, they've already got their plans and the permits
Mhm.
submitted. Somebody
Mm-hmm.
wants to step in, they're sort of locked into using that developing company.
Mm-hmm.
That's going to be that could be, I'm not saying it's impossible, just saying it could be a hard sell.
They can, but the development company is also one of the partners in the ownership. So they would be interested in either finishing out the development or assigning whatever those plans are over to the new um, to the buyer or to the new developer that purchases the project. And they so get this. So while they were building, they wanted to test the market and see who would be interested in leasing space at this location. And they have 120 units, but the what they did, they got 100 people interested in leasing space. So they actually had to unlist the property. So there is a need there. So I'm wondering if could be one of the selling points or parts to it.
Possibly. I'm not saying I'm not going to put my foot in my mouth and say no, but I'm also not going to say, oh, absolutely. I don't know of anybody that would step in. I mean, I can reach out to my network to see if anybody has any interest in
Okay.
that type of development. But
Yeah, I would love that. I'll drop here in the chat what the flyer that I have for it. They can reach out to me. I'm actually posting it as a broker.
uh-huh. Okay.
Um,
Moses, I guess you're from New York City.
Yep. Five boroughs.
Okay. Okay.
Yeah. Yeah. Alicia, I was listening and I think I'm the same boat with Edwin. I mean, there is possibility, but I also have to look at the timing of where we are in the market, and that's going to be the driver. Um, yeah.
Yeah.
And
I wasn't going to mention that, Alicia, but I will say that they're probably going to have to sell that at a pretty good discount, meaning a loss. They're probably going to have to take a
We're gonna
loss.
have to take a loss.
Oh yeah, and probably a pretty steep loss. It's going to get nasty for the multifamily commercial, even in Texas. Matter of fact, I think Texas is a potentially a hidden time bomb. You've got a lot of development happening in Texas because of
mhm.
all the demand for the past couple of years, as well as I recently saw that Tesla's laying off like because the whole EV market is collapsing in the U.S. Tesla's not meeting their metrics. Ford released that for every EV vehicle they sold, they lost $130,000 on. So every EV vehicle was costing the company $130,000. I think they lost this past year right around $6 billion in 2023 by switching because of the current administration and their push for electric. And the consumer's not on board. It's not something that the consumer wants to. So I say that I am actually, while I might have been interested in investing in some Texas syndication as a co-GP or an LP in the past year, right now I'm sort of putting any brakes on investing in Texas, but that's me personally. And right now I'm only investing in Florida anyway. And I know some people would say, well, I would never touch Florida, and I get that, but I'm from the area, so yeah. But yeah, as long as they're aware of the position they're in, if they really want to get out, then yeah, it's unfortunate, but they're probably going to take a good sized haircut on that.
So tell me, what would be some of the things that you look at? Because with this property, it would be making about 430,000 a year. So I think that's about,
Well, I mean, it depends on the debt service that you've got. I mean, there's a
Uh-huh.
lot of factors that I don't have in front of me to say, what I would have to buy it at to make for it to make sense. But we're still in the development stage, so you're talking 120 unit. And when you say there's 60% complete with the development, we're talking about horizontals, right? Horizontal street, water, sewer, like the horizontal. We're not talking any foundation or going vertical yet.
no, so 5 buildings are completely built.
Okay, so
Yeah,
okay, all right.
so
So
it's
it's not the
60,
development of the land, it is the actual vertical construction is 60% complete.
correct,
Okay. Okay.
correct. The
Well,
phase
then
two, so to speak.
that's different. I was sorry.
Okay,
I'm under when I hear development, I understand that to be the roadways, sewage, water, what we call horizontal. So when you say
Mhm.
development, that's what I'm thinking of. Typically, when it's being erected, it's the vertical construction. So okay, well then that actually might be, they're a lot closer to completion. Um,
So I'm gonna show
yeah.
you a quick snapshot of what it looks like. So what they need to do, because they have 5 buildings done,
Hmm.
they have these 5 buildings done. These are the two that need to get completed.
Uh-huh.
And then they just need to do like the grounds before they're able to finish out with filling the buildings that are constructed.
So that's good because the project is slated to be a $15 million project, right? And they're looking to
Correct.
sell it for 9 million.
9.5, yeah.
How are they trying to base that 9.5 percentage as 60% of the 15, and that 15 is the fully leased out and completed valuation?
I believe so. If I'm
Yeah.
understanding you correctly, yeah.
Okay. And how much left on the construction side?
40%.
Well, but I mean, so
So they
between
have to put
6 million
in,
approximately?
yeah, I would say under 6 million is what they're
Okay.
estimating.
So then I will recant what I just said and go back to my previous statement.
Okay.
What you've got is a seller that's looking to get basically an A class. It's probably a 4 cap or a 5 cap on that.
Hmm.
I don't know what that is.
That's Zoom because you did the thumbs up.
Yeah, I would say that they're trying to, it sounds to me like they're actually trying to make the profit based on what the AR, like the completed and fully leased out value is at 50 million, and where they're at now, they're estimating they could sell it for 9 million. I'd be very interested to see how much they actually have invested into the project at this point. What are the hard costs, including land acquisition? I would be a hard pass to say that they've put 9 million into it, but probably closer to, we've got horizontals, 5 constructed, 5 partially, 2 yet to be right at foundation framing stage. So I would imagine they probably have around 6.5 to 7 million in the project. So I would
Yep.
say that again, they need to be prepared to, if they can sell it at par, that would be great. I think that would be a win if they get out at par.
Mhm.
Yeah,
Okay.
at par. If they can get out at par, that would be a win. But I would be prepared probably to get offers around 5 million, 5.5 for that project as it sits.
Okay. Okay, cool. Thank you. That's what I was thinking. We did share that with them, but we'll see what we can do.
Okay. I'll reach out. I'll reach out to see if anybody that I'm connected with might have interest in
Okay.
that. So, and
Okay.
I'll keep my thoughts to myself. I'll just let them do their own diligence.
No, I appreciate that because that lets me know that I was on a very similar path as you are, as far as providing them with information and kind of giving them an idea of what sellers are looking at, especially in the Texas market. Because one, I know insurance is going up whether you're close to the water or not. Then there is the taxes that they've increased, and people are concerned about that. And then people also are slowing down their process of purchasing because they see some of the larger houses that were investing that are now in trouble because they did some risky investments or they just,
Yep.
weren't willing to put up the capital to keep it. So they're aware, but I'm
Is
still
everybody on the?
hopeful.
I know that Alicia, you're a syndicator. You're on the GP side. Is
Mhm.
everybody else a syndicator, GP side? What do you play in, Stephanie?
I am just now getting started, so.
Okay, okay.
Yeah.
And then Moses?
I'm on both sides, but fortunately for me, I got out of my GP's role last year, so I'm
Okay,
hanging loose. Yeah,
okay.
but I
But
do have.
nobody operates on the debt side. That's what I'm understanding. I know Stephanie, you're just getting started, so you're probably still trying to find your niche.
So Sonia May, I know her and her husband and some of their friends and family, they invest throughout the country as well. And when you say debt side, are you referring to like the JV side or putting up the capital for the investment?
Yeah, so that's a great question. Both of those are considered equity investments. And that's one of the confusing things that, and I'm not knocking syndicators, but I think it's incumbent upon syndicators, GPs, sponsors, fund managers to educate their investors which side of the capital stack the investor's money is being dedicated towards and what are the risks to those capital stacks. Because syndications, by and large, you're raising money for the purchase price, the operational costs, OPEX. You're raising capital for construction, possibly. Whatever the bank's not funding, you're raising the remaining amount for a projection of 2-3 years until the property's performing, right? But that's all equity because at the end of the day, if the numbers don't pencil out, or let's say not the numbers, because obviously the numbers penciled out if you did the loan or if you did the deal, but in reality, the numbers are not working out as you plan. Rates, for instance, my full expectation is we will see rate increases before the end of the year. We're not going to see any rate decreases. Everybody who's holding out right now, and Alicia, you mentioned that to where investors are sort of staying back from getting involved, but the buyers are staying back because they want to see the rates come down. The sellers are staying back, or they're forced to stay back because the rates are up and they're hoping the rates come down. And I think this stagnation that's going to happen in the multifamily and commercial is only going to increase, and maybe even go the opposite way. We're not going to see a rate decrease. And my full expectation is, I hope I'm wrong. I really hope I'm wrong. But my full expectation is we will see a rate increase, and that will be a shock to the market. And I think that'll happen before the end of Q4, after the elections, but definitely before end of Q4. But on the debt and equity side, no, all the positions or the uses of the capital that you just mentioned, that's all equity. So on the debt side, we issue the loan. We are what you would call an originator. We are a portfolio lender. So my fund, we make the loan, we create that loan, we loan out the money, and then we service that loan in-house. We don't sell it to the secondary market. We're not utilizing arbitrage or hypothecation. It's simply our capital that we're managing inside the fund in loans. When the loan pays back, then we get the principal back, right? So that's on the debt side. You're basically paying the investors that invest in debt are more concerned about capital preservation. They're more concerned about dependable monthly income, and they're more concerned about security and safety. Therefore, they're willing to sacrifice the returns of equity. And as you all know, syndications, hey, there's some great potential there for great returns when the market is in that situation. So that was something that I think it was either last week or 2 or 3 weeks ago that I had mentioned it here on the call, that investors as syndicators, as GPs, as fund managers, we absolutely need to be forcing ourselves to be educated in other methods of utilizing capital in equity and or in debt, and being able to bring to bear those different opportunities to our investors, because the market's going to change. And if all I'm focused on is in debt, when the market gets really good, all the money is going to leave looking for the equity side, right? The equity plays, which was one of my disadvantages in the past, I don't know, 8 years. When equity was skyrocketing, I was still on the debt side, and I missed out on a lot of opportunities because I wasn't invested in equity. Now that I'm on the debt side, a lot of equity focused investors, syndicators, are, if you're not able to identify and properly underwrite those debt opportunities or other type of opportunities just besides a straight equity, then you could be putting your capital, your investors' capital at risk, or you could just be missing out on some great opportunities to preserve the capital through the next couple of quarters, maybe even years, hopefully not that long. But yeah.
No, that's awesome that you bring that up. So, Sonia's internet is a little shaky right now. She's over on the beautiful hillside in California, but she mentioned they do also operate as the bank. They do GP in the fund side, but they also operate as a bank. She wanted to know though, what are the trust deeds considered?
So that's a great question, Sonia. So in the world of debt, most people are familiar with debt, even though they may not think they're familiar with debt. If you've ever bought a property, then you're familiar with debt because you've had to go get a loan from a bank, unless you bought it all cash, right? So you understand the process of getting a loan. Becoming the bank, or thinking, investing, and analyzing like a bank, is not that far of a shift. It's a pretty easy thing to do. Trust deed and a mortgage, and Georgia is one of the only states in the union that has this third security instrument. It's called a security deed, but all three of those are security deeds, or security instruments. So you have security deed in Georgia, and then you have in Georgia also has the deed of trust and the mortgage. The type of security instrument is going to be dependent upon the foreclosure laws of the state that you're lending in. So for instance, Arkansas, I was talking to an investor earlier today, capital investor. He was interested in investing in our fund, and he was asking about Arkansas lending laws. And Arkansas is both a deed of trust and a mortgage state, which means that that state has both judicial and non-judicial foreclosures. If you record your loan using a deed of trust, then you automatically fall underneath the non-judicial foreclosure process, which means less time. It's easier to take the property back. You don't have to go through the courts. You basically put the property right into a sheriff's sale. That's why Texas is known as one of the most friendly states. If you as a lender, because it's a deed of trust state, if you as a lender incur a default by your borrower, you can take that property back in 21 days. It's one of the best states to do lending in as far as deeds of trust. If you're recording a mortgage, if you're securing your loan via a mortgage, you are now falling underneath the judicial foreclosure process, which means you have to get an attorney, you have to go to the courts, and all of that. Now, the benefits of a mortgage over a deed of trust is the title is absolutely clean in a mortgage foreclosure. In a deed of trust, there can be additional attachments or additional liens that might filter through. So even if you're using a deed of trust, you still want to get an attorney to manage that through the foreclosure process, just to make sure that the title is completely clear. But yes, Sonia, that's what a deed of trust is. It's simply the security instrument. And by the way, if I may adamantly recommend, if you're investing in debt and somebody gives you a promissory note and says your money is secured to this asset, it is not secured. You have just made an unsecured loan. And there is a very high chance, actually, no, not a high chance, it's an absolute fact. If that borrower does not pay you, you have no recourse. You've given them the money and hope that they're going to pay you back. The only way to secure loans is through a security instrument, i.e. a debt or a mortgage, a deed of trust, or security deed, depending on the state.
Yeah, we have that now, Edwin, but
Uh-huh.
our very first, and so we've done very well. But the very first one, you're absolutely 100% right. We got screwed so much because it's nuclear. We didn't go through the whole process. So it took us to make up the money we lost on that, maybe 3 years, because it's like over 400,000 we lost on the very first one. But now we do it with all the securities in place. We didn't know that was a rule, but you're 100% right. Wish I spoke to you before we did the first one.
You know, it's interesting. This has become a recurring theme in the last month and a half. So I literally have developed a 12 module course, A to Z, nuts to bolts, taking somebody that knows nothing about debt, knows nothing about loans. I mean, and it's no sizzle, it's straight steak. A to Z. How do you find the borrowers? How do you vet the borrowers? How do you vet and identify the loans, the property, the project? How do you underwrite that loan? How do you create the loan? What's necessary? What key players do you need to have in place? And then how do you service that loan? How do you manage that loan all the way through until it's paid back? A to Z, like everything. And so it's about a 35-hour course. I would say it's equivalent to like a batch or an associate's degree in college. As
That's
far as
awesome.
the amount of information. And I still have not finished it, but I've had multiple people say the same thing that you just said, Sonia. Man, I wish I would have talked to you before I did that or before I did this.
And where is that course offered?
It's not, I haven't completed it yet. So I need to do the recordings. I've even got all of the like all the handouts, all the worksheets. Like the bones are completely done. I just got to put on the nice makeup on the skin, if you will, and then complete it. But I've had quite a few, Sonia, that have reached out and said, man, I wish I would have talked to you before. So it's a motivating factor for me to get it done.
Well, I'm sure Jim would be interested in it,
Yes.
especially offering it, to our network. I know several investors.
Well, I will say I'm going to need, like every course that gets launched. I think it's the perfect baby, right? But I might hand it to you, and you might say, "Wow, this is one gargoyle looking dude," right? So, I will need some tests, guinea pigs, if you will. So, yeah, when I get to that point, believe me, consider it done. I'll reach out to Jim and you guys and say, hey, if anybody wants to participate and get a pretty deep discount, but help me refine this beast, then yeah, we'll see what we can do.
Awesome,
Great.
awesome. So, did you have any additional questions? Because I know that you're in that environment.
I think what Edwin said was correct. It's like when you're looking at it now, being in the debt market right now is a place to be, because we had gotten out of it for a while, and I know my husband did 2 more deals in it because he feels like it's a safer place right now. You can always switch back, but it's a safer place right now. So we did a couple more. But
And
you
you,
have to do
Sonia, I'm sorry, go ahead.
now, so you have to do your research with that too. When you see the properties, you have to do some research with that too, but it's not as incumbent as, taking a property into a multifamily syndication, especially with the problems some of the groups are having right now.
Right, right. So, what are some of the things that you look at, especially someone starting out, right? If they want to be the bank, do they have to have a few 100,000 saved up? Does it have to be over 1 million? What does that look like?
You know what? That has been probably the biggest hurdle, unspoken, and most people don't even think about becoming and thinking like the bank, because that's what they think. They're like, man, if I'm going to do loans, and the average purchase price in the U.S. is like, I think right now across the United States, the entire average is over 400,000 on an average purchase price, which is
Yeah.
astronomical. I mean, absolutely astronomical. Well, if you've got $1 million, that's basically 2 loans. That means and think about this. If you've got $1 million, okay, yeah, you could be the bank, do 2 loans, or you can invest in what?
Several deals.
Like 20 syndications at $50,000 a pop. You've
Yeah.
got better diversification if you've got $1 million investing in syndications than you do investing in loans. Why? Well, because in investing in loan, you have to have the money. And so one of the things that my attorneys and I developed many, many years ago, because I was struggling with this, like I was being taught through some mentors, and it's not a course or anything, it was just people that I'd met, and we would get on Skype calls from 2010 to 2014. And they would ask me quite like I was listening. I had it was a privilege. I was privileged to be invited into that little small, well, I won't even call it a mastermind. It was just a couple of friends that all did private lending, two gentlemen in California, a gentleman in Colorado, husband and wife in Alabama, and another gentleman in Texas. And so it was the grace of God that I was connected with these people. But I would get on these Skype calls and they would talk about the deals that they were doing, how they were underwriting, what were some of their concerns, and they would advise each other on, well, make sure you look at this, make sure you look at that, make sure you have this lined in. And so I was sitting in these calls, and then they would ask me, Ed, you're going down to Florida, because I was in North Carolina at the time. Like, you're going down to Florida. What are the Florida laws? Well, I don't know. Well, get back to us next month. Let us know what the Florida law. Oh, and by the way, don't just come back and say this is what the law says. We want to see the proof. Where is the actual law at? Show us the statute and exactly what page in the statute and the sub. And I was like, okay. So it forced me to actually do diligent research. And so I studied for 4 years before I made my first loan. And during that time, that's one of the hurdles that I realized, like, I didn't come from money. Like my parents are blue collar. My mom was a stay-at-home mom. She works at the church. My dad owned some restaurants, but he went bankrupt and while I was a junior in high school, so he lost everything. So I didn't come from money. And through these 4 years, they introduced me to I got to plug in with their network, their attorneys. And one of the attorneys is based out of Nevada. It's not Anderson Advisors. This is a small attorney firm. And they created for us what's called a specialized lending trust, SLT. And the SLT, I've got the rights to that. And then basically all we do is we create a new trust for every loan that we're going to do. It costs me $250. If you've ever created trust, you know that is an absolute steal of a deal. And then I get that trust and I can place settlers within the trust. So family, friends, and guys I served with in the military. That's how I did my first deal. The first deal was like a $120,000 loan to a fix and flipper in Pensacola, Florida. And I had my uncle funded a good portion. He funded like 50,000. Had a couple of buddies in the military that dropped in like 10,000 each. And then I had 15,000 that I dropped in. And so that's how I made my first loan. But after that, I was like, I can do this. And I did that while I was deployed to Afghanistan. So I then realized that unlike, like, if you're the one that's buying the property, or you're like, you have to be at least have somebody boots on the ground. Probably, like, if I was ever going to invest in a syndicator and they said, well, we don't visit the property, that's a no-go for me. Like, I'm not even interested in investing with you. So I want to know that you, as the buyer of the property, whether it's commercial, multifamily, single family, like, you're at the property, right? But as a lender, I don't need to be there. And matter of fact, I started to realize, like, all the professionals that are in the industry, they're all licensed. They all have, the attorneys have the bar that they have to pass. Title companies, escrow companies, they all have to have insurances. They all have to have license, brokers, inspectors, appraisers. Like, all these people have to be licensed in the industry. And all of these people, I got to dictate. I got to tell the borrower, you're going to use this title company. You're going to use this appraiser. You're going to use this inspector. This is what it costs. And to get my money, you have to pay for that before I loan you the money. There's no other, and I'm sorry, I'm taking up a lot of time here, but in my opinion, there's no other way to invest passively in real estate, mitigate as much risk as you can, and have somebody else pay for all that risk mitigation. And that's on the debt side. That's exactly what happens. Like, you get to dictate, these are my terms. If you want to borrow my money, you have to jump through these hoops to borrow my money. And I get to set up as many protections and as many risk mitigation courses of action that I can. So yeah, but to answer your question, your question, Alicia, it was the specialized lending trust. And so it allowed people with much smaller dollar amounts to get participate with me in the loans. And that's sort of how I started.
So right before, I'm sorry, Sonia. Right before we get to Stephanie's question, because she does have a question.
Okay.
What are, like, the typical interest rates and points for a loan do you look at when you go to lend the money? Because I know that I've been asked that, and I'm always looking at the US Treasury and trying to make some type of assessment. Is that the
Uh-huh.
process that you follow?
No, no. I
Okay.
follow this one process. How much money do I want to make?
Okay. That makes
That's
sense.
it. And this is the reason why. If you were to go to a bank, what are some of the things that the bank's going to look at before they decide whether you're credit worthy?
Hmm. Yeah, they're going to look at the US Treasury and how much their return is going to be,
Mhm. And they're probably going to look at the property, the performance of the property, right?
for sure. And the
Will the
condition.
income, and that's on the, which is a benefit on the commercial multifamily side. Like you don't personally have to qualify for anything. Now, I don't know because I've not been on the GP side. Maybe Moses can answer this, or even Sonia. I don't think they look at your personal credit worthiness, but I'm sure at some point they do. Like the bank, even though they're lending you money, do they look at your personal credit worthiness or do they not?
It depends on the sponsor. They do
Okay.
look at your PFS.
Okay. Okay.
Mhm.
So for me, when I'm looking at a borrower, I don't look at any of that. Now, I'm not going to make a loan to somebody that's had a bankruptcy or foreclosure within the last 2 years, bankruptcy within the last 4 years. That's my standard as far as credit worthiness. But everything beyond that is who is the team that they have in place. Um, and then because I'm not looking at credit, that's a big attractant to builders and flippers because if they got their credit pulled every time they were going to buy a property, their credit would be shot, right? So using somebody like me is a huge benefit because my loan never occurs on their books. Like the banks don't ever see my loan on their books. So that's one, the fact that I can close quickly. I'm the decision maker. I'm not trying to sell the loan to Wall Street, which means the secondary market, which means somebody else is actually the approving authority.
Mhm.
I'm the approving authority. I look at every loan. I do my own underwriting. I have a team, but at the end of the day, I'm reviewing all the underwriting that's happening and I'm approving that loan or denying that loan. So my average rate to the investors is anywhere from 10% all the way up to 13%. And that's just the annual interest rate. And then what I charge on the points between 2 and 3 points. The more that I do business with somebody, the lower the rate will go and the less points. So there's that motivation to continue to use me, build that long-term relationship. And guess what? That gets rewarded with lower rates, less fees, and then of course more business for me.
Awesome, Stephanie.
Yeah. I think you call it SLT trust. Is that a revocable trust?
It is an irrevocable trust.
It's irrevocable.
Yes, ma'am. It is an irrevocable trust. The way that we structured it, we wanted the trustee, which was my company, to have absolute control over the performance of that loan. If the loan started to go south, then I did not want any of the other beneficiaries, i.e., the investors, to start throwing in wrenches into the pot that said, "Well, we want to extend, or maybe we don't want to foreclose." And it's like, no, I'm the one that put this together. I'm the one managing. Then I'm going to manage the loan and I will make the hard decision that needs to be made if it needs to be made. And also the other side to where, hey, we've got a really beautiful property. We had this deal actually right where you were talking about, Stephanie, there in the Panhandle. It was in Santa Rosa Beach. We did a renovation on a 3-story property. We loaned the money for renovation, and the borrower he had too many projects at one time. He got additional projects after we made the loan, so we had to go in and foreclose on him. We got like a $1.5 million property. Now, when he started default, because he was a borrower that had done a lot of business with us in the past, my investors were like licking their chops. They're like, man, our loan was 650,000 and the property at ARV was 1.5. Like we were really well protected. He did not want to default, but he couldn't afford the payments. He got behind on the construction. There were a lot of things that he was doing that was causing the default clauses in our mortgage to trigger. And so I negotiated with them. I tried to help him out as much as possible because I didn't want to take the property back. I wanted him to finish. But the investors were, as soon like the very first payment that he was late on, they were like, foreclose on him. I was like, hold up, guys. Like, let's have some grace. Let's see what's going on first before we just jump the gun and declare default. And so that's the other reason I wanted to in an irrevocable trust, Stephanie, is I wanted absolute control so that, hey, whether the investors enjoyed being in the deal, whatever the case was, I was the one that put it together and I was going to manage it to their benefit, even though they may not have seen it that way at the beginning.
So Alicia, I put a link to listen to Edwin, and you know, Edwin, my background is real estate. I teach from time to time. I have youths and community, you know, facilities, and I always wanted to see somewhere where they can start and look, because I'm the chairman for a local credit union, so I understand when you bring your money in, I when I give you your 0.05%, I know where I can go and make 5, 6, and you're happy.
Like that yield spread.
Yeah, the yield spread. So I got that background, and you know, the last couple of years you see people running at Treasury and they're now making 5.5. But one of the companies that I have used, and this is for my portfolio and my kids, you know, and I like it because I wanted them to understand real estate, but they can't go on the equity side like as an LP, you know, for many different reasons. But if you go to ground floor, I'm sure you probably heard of them or you may have seen them, but I like the platform just because I can look and do my due diligence on every property that I put my money from the debt side on it.
Mhm.
And you can make anywhere from 11 to 15% depending on, and they rate the properties themselves from A to F. The higher the letter in the alphabet, the higher the return because the more risk you're taking. But I like to go back and underwrite it as if it's from you know, from a GP or an LP position, and I want to make sure that property is going to pan out. But I show the kids, go to realtor.com. It's single family mainly. They now have labs, which is similar to syndication. But I let them go and look for what properties are selling for in the area. What are the demographics? What are the crime? So then they could decide if that's a good investment for them. But they could do it as little as $100 and up, but they get their 10% return, and they look at the bank and they're laughing like, hey, that's why I'm not coming over there. I just made 10% here.
Yeah.
You know, but I got cash parked there as well, just sitting waiting to deploy. But that's, you could do 3 months, you could do 1 month. They got a whole, and they got a little side of it. I think it's called steps, but that's like fixed 6 to 8% and no sweat. You want your money in and out. But I think it's a good platform. But I do have the debt side investment. That's who I use, and I like it because if there's a foreclosure on a property, they deal with all of that. I have nothing to do with that, and the points that they charge comes off of the top up front. Whatever they promise to pay is coming straight to the investor. There's no cutting, there's no spread, anything in between.
Awesome. Awesome. Wonderful. I believe Sonia also had some either input or a question. Sonia, are you still there?
Edwin, while we're waiting on that, can you put your contact information in the chat?
Yes,
please?
ma'am. Yes,
Thanks.
ma'am.
Thank you, Moses. Yeah, every time you hop on, I learn something additional over the last few years. So that's awesome. I love it. I love seeing especially everyone's growth and where our calls are coming from. They build, you know, and I think that this is a really good tool on how we're able to educate the network and also partner on future deals. Rhonda and I are working on an opportunity. This one is also in Texas. It's in Crosby, Texas. And we're looking for investors as well. This opportunity is that RV resort opportunity. So Edwin and Moses and Sonia, for those of you who do or are on the debt side, do you invest or loan funds for those types of assets? And if so, what are you looking for? This, and then keep in mind that this is a 99 pad community and it's more on the luxury side. Don't all answer at one time.
Yeah,
No.
just a second. I'm trying to get, I've got a link for my contact information.
Okay. Okay. Awesome. Yeah, it's over there.
So your question, Alicia, is do I lend on
RV resorts.
RV
They're
resorts?
new development. So there's the phase one where it does do the vertical and the horizontal. It's two phases. Right now, we're in that first phase where the engineers are doing their the plans drawn up, all of
Uh-huh.
that good stuff. The operators are experienced. They've done development projects. They've done fix and flips, commercial, residential. They've been in the industry for at least one of them a few decades, the other just under a decade. So, what do you look at and do you loan on that type of asset?
So I can answer what I'll look at, but I'll go ahead and answer the other one. I do not lend on that type of asset,
Okay.
primarily because I don't know how to underwrite that asset. So for me, as a debt investor, as the originator, before I lend on an asset type, I want to know how to underwrite that asset type. Now, once you understand underwriting, it's fairly easy to go out and develop your underwriting guidelines for an asset. You just make small adjustments based on different metrics that you're looking at, right? At
Mhm.
the end of the day, though, I personally don't lend outside of Florida, so I know the Florida law, I know the Florida markets. So there's 26 MSAs, or metropolitan statistical areas, which are basically your big areas that are around major cities. And I know Florida like the back of my hand. I also am not right now lending on commercial or multifamily assets, primarily because of where the market's at. I would consider that even though it's an RV, it's sort of a mix between multifamily and land, because that's really the play is the land side on the RV park. So for those would be the primary reasons I wouldn't lend on an RV park. But more importantly, here's the other thing. I have investors that I need to pay, like who are invested in the fund, and they're expecting a certain amount of return. I then have to make money on my fund, just like all of you in your funds that you manage. So my minimum is 10%, and I typically collect a 2% yield spread, and 10% would be really low. For a new development project, that's probably going to be several years, maybe a little bit shorter, but then there's going to be, are they going to be able to refinance out of my high rate loan to a lower rate loan? I'm the only developers that I've ever loaned to are in the single family space, because they can get the house built, depending on its size, within 15 months or less, right? So their exposure to my high interest rate is not that great. You start getting into commercial multifamily or large projects like that, you're not talking about a 15 month development. You're talking 2 years development or longer, just depending. And who knows, the states like California, try to get permits pulled and everything approved in less than 6 months. Good luck. And Jesus will
Right.
come back before that happens. So it's one of those things where for financial sense, it just makes sense for the commercial and multifamily side and large developments like that to go to the financial institutions to get the loans, right? Because the financial institutions like Moses is part of, they're leveraging the Fed at prime plus whatever their spread is, but it's still going to be way significantly less than what I would be willing to offer, right? So
Mhm.
the numbers just would very rarely pencil out in a development project on something that large using my rates.
Okay. Awesome. Good to know.
And,
For
and
the
Elise,
Yeah, and
yeah.
someone like Edwin's company will
Mhm.
come to me or other investors, and they will have to put it on their platform or have to go through the due diligence to bring it to us. So that would be somebody, I guess you have to get to people like Edwin who do debt, Edwin, who in that debt arena to buy into it. Because he would have to bring it to investors. Like I'm saying, for me, we invest in debt, but only through third parties. So your company or other companies come to us. So if it's not sent to us, we wouldn't know about it, and therefore, we wouldn't be investing. And we go through, I guess it's 2 or 3 companies we've been using.
Yeah, so you're right. You're right, Sonia. You're what we would call the secondary market, or
Right.
like a secondary market, right? Like you're the capital stack. You're on the debt side of the capital stack, but you're the one providing the capital. And then in
Right.
that case, I would be more like the broker, if
Right.
I did it that way. The way that my fund operates is, so my management company, we actually make all the investments first. I do the
Okay.
underwriting. We actually close on the loan. It's in my company's name, or the management or the fund's name, but it's the management company's capital. So I've already said, this is a deal. I'm putting my money where my mouth is. I'm making this loan. I'm making this investment in syndication, whatever that is that we're investing in. I've already made that. And so the investors on our platform, we use Avestor. When I list that investment as an opportunity on the platform, it's already made. Like if they want to invest in it, take a fractional portion, hey, more power to you. If you don't, that's fine, because I've already made the investment. And I think that's something different than syndicators, because syndicators are raising the money to then go out and purchase the property. It would be as if, hey, if you're going to do an investment, Sonia or Alicia or Stephanie or anybody here, you already had the money. You went ahead and made the investment into the syndication, whether it's 500, a million, 2 million, whatever that is. And then you turned around and said, okay, now we're going to basically sell out portions of this already made investment. And that's what we do. We already have the investment made. If somebody in our fund wants to invest or buy a fractional portion of whatever that investment is, more than welcome to. If they don't, it doesn't matter, because I've already invested. Like we're already earning a return on that money, or on that investment anyway.
So does Alicia, can she go to like the company we work with? I think I sent you an email on it too, like American Private Mortgage Company, whatever company it is we're working with. They sent us an email and they're saying to us, here are 4 opportunities. One may be at $1 million, one may be at 500,000, 300, whatever. Would she go to a company like that so she can get on that platform? I just thought of that now. That's something she could probably do, right?
Yeah. And it's really, Alicia, what you're going to want to look for is a broker. And that's what a broker is. Now, in the industry, it has become really, the lines have been blurred. Brokers will call themselves lenders. They don't like to call themselves brokers anymore because it's a bad connotation. So if you're looking for a lending company, one of the best things that you could ask a lending company is, so that you could prepare yourself, right? Is the lender, are they the direct underwriting approval authority? Meaning
Yes.
it's their money. In the case like American Mortgage, they're not. They're
Right.
simply a broker, because the real decision maker is Sonia. Like
Yeah,
it's
it
her
used to
money.
be.
Right.
And she's
Right.
the one that's saying, okay, has the broker or the lender, have they prepared
Right.
for us all the documents for us to do the underwriting?
Right.
But ultimately, at the end of the day, it's Sonia's decision. And so what that puts you at, Alicia, and this is what, if you've ever heard or talked to an investor that's like, man, we almost were at closing and then the lender backed out. It wasn't the lender that backed out. It was the secondary market who was providing the actual capital that took a look at all the underwriting and said, no, that's not a good deal. And it's the broker who's really the face of the company, the lender, right? Because they're holding themselves, hey, we've got the money. No, they don't have any money.
Right.
They're simply creating these loan structures in hopes that somebody on the secondary market is going to say, oh yeah, that's a good deal. I'll fund that loan, right? So those are the two. You have a portfolio lender, which is what I am. And then you have a broker, which they call themselves lenders now. And it's not their capital. They're simply finding people like Sonia. And we work with brokers too. Like I'm not all about going out and just, hey, finding borrowers. I want to work with brokers too that, come to us and say, hey, we've got a deal that we've collected all the underwriting. We've done everything. Is this a deal you would fund? We then go through all the information and put it through our underwriting checklist. And, if it meets our criteria, then yeah, we'll fund the deal. But if not, then I don't lose any skin by denying it. But it's that lender that's going to have that hard conversation with you after they've told you, yeah, we can fund the deal. And they probably made you go and buy an appraisal, get an inspection. Like you had to put money up front to get all this done. Then at the end of the day, the lender says, oh, sorry, we can't do the deal. Well, it's because they didn't have control of the money.
Right. Wow. Thank you so much, Edwin. And just to kind of recap that section, I call the brokers on the lending side, I call them connectors because that helps, just the layman when they're
Yeah.
trying to understand, they're the
Mhm.
connector. They vetted these lenders, they know which lenders will do, certain things and what type of products that they like to lend on.
Mhm.
But sometimes they have to go through another level as
Yeah.
well to get down to the money, the actual money person.
And that's interesting too, Alicia, because in the case that, let's say, and that this was happening all through 2018, all the way through 2022, it's pretty much all been stopped. But you had a lot of, uh, I would hold myself like, okay, so Sonia would hold her, hey, Ed, I've got the money, you're a broker, find me deals. So I'm out there and I'm trying to find, I come across you, Alicia, and you say, hey, I've got this. And I look at what Sonia's told me that she's willing to invest. Guess what? Your deal meets her investment. So I start gathering all the information. I negotiate terms with you, right? Because I know what Sonia needs. I know what you want. We negotiate terms, Alicia, you and I, and then I go to Sonia. What happened from 2000 and we really became big in 2018, but it started around 2015 and 16. Sonia, it wasn't even her money. She had built a broker relationship with RCN, Vizio, Patch of Land, any of these large Torok Capital, these large actual secondary market buyers, and it wasn't even their money. They were getting money from Wall Street. So you actually had 4 or 5 different levels of approval, and none of them had approval except for the one that actually controlled the capital, which if you trace the money back and it goes back to Wall Street, it's always Wall Street. It's the big hedge funds that are packaging these mortgage-backed securities and buying them, and then they're putting that money out on the street. Well, it goes from the Wall Street hedge fund to Torok Capital. Torok Capital has a line of credit and they're making about 0.25% yield spread on the money that they're making available to Sonia. Sonia is then saying, hey, well, I want to make at least a point yield spread. So she's adding a point onto her money that she's going to give me. I'm, as a broker, want to make a couple of percent. So by the time it gets to you, it's that's the disadvantage of working through a connector, is there's a lot of additional cost on that to where sometimes it doesn't make sense.
Right. You think that is 1%, but it's actually 5. Get it. So, does anyone have any other questions? I want to be respectful of everyone's time here. We do meet again next week on Wednesday. So, same time, same place, 11 a.m. Pacific Standard Time. I believe that's 2 p.m. Eastern Standard Time.
It is.
2. Okay. See, I did that from memory and I have to count on my fingers. I did drop some information in the chat. You all are experienced folks. You've been with us for a while, so you already know. But for those of you that may be listening to this via YouTube or one of our social media channels, we will drop all of these links in the chat. For those that are on the call, if you don't already have the YouTube station for GLB Network and also Commercial Multifamily Masterminds, the links are there. Our ladies group meets on the second Wednesday of every month. We were able to meet earlier. We had a really great call, and we'll post that video later on as well as the Tuesday calls for Commercial Multifamily Mastermind every other Tuesday. So guess what? That's May 14th. We will be meeting again. I'm sure Daryl will post who the speaker is. He goes into that underwriting that both Edwin, Sonia, and Moses referenced in today's call. But we have a lot of cool and exciting things coming up. GOB Fund, that's at GOBFUND.com. And then you can also visit us on our GOB Network Arizona call. We got to get one out there in Tampa, Florida, Edwin. So you let us know when you're ready. But thank you all for joining us today. We look forward to seeing you next week.
Thank
Thank
you.
you, guys. Thank you, Alicia.
Bye-bye.
Bye.